Isn't it interesting somehow how economic students seem to say that upon graduation they don't really know what they want to use conduct as production function to do? I was in a seminar when I had a particular economic student. I think he finished on a first class, all right, from University of Ibadan. Okay, and he was saying that he had never used the national income, the King's, I think, national income model in his life, like at his workplace. He was even the guy was he's actually a brilliant professional, and we had to remind him. I mean, the audience had to remind him what C plus I plus Z plus NX was. Okay, C is consumption basically. These are things that we learn under national income, and we've done several videos on that already. Where I is gross investment, right? G is government spending, NS is net exports. But this guy was just trying to say that he had never used. And you know, when you hear stuff like this, you tend to wonder why you are in school in the first place. But today we'll be talking about a topic that we deal with in economics, and I think this is also treated in finance, and which is actually important in the real world. So, how important is present value to investment decisions? So, if you are a business person or you want to be a business person, so what is present value? I think that's the first question. And then what is investment? Okay, I think every other thing are words that we are used to already, decisions and whatever like that. So, investment, as far as economics is concerned, is the increase in capital stock. Okay, the increase in capital. So it's not putting money into bonds, it's not putting money into other financial assets, something like that. So it's all about how you are increasing the stock of capital. If you have a plant and you want to double it, you want to increase its size, so that is an investment because there's an existing stock that you want to improve upon. So then what is present value, which is the fundamental thing that I think this video is all about. So present value is the current value of a future amount given a specified rate of return, and the specified rate of return is known as the discount rate. It's known as the discount rate. So this definition might look somehow maybe not that straightforward. To some extent, I do think that present value is kind of the amount of principal, okay, that is needed today in order to get a future amount, in order to get a future amount at a discount rate. Okay, because we need discount rate. Now the question is then, what is the discount rate? All right, a discount rate is actually a foregone interest rate, and it seems I'm just saying something that you don't even really understand. All right, we understand, or by now you should know that interest rate is simply the interest, all right, that an investment yields expressed in terms of the investment and in percentages. So when you express when you have interest over principal amount multiplied by 100, so that gives us the interest rate. So if I should invest, let me say, if 500 naira today becomes a 550 naira tomorrow, so the 50 naira on it is the interest. So 50 divided by 500 multiplied by 100 is then going to give me my interest rate. So 50 divided by 500, that's what, 1 over 10, right? Multiplied by 10, that's 10%. Okay. So how is discount rate different from interest rate? So I just explained them interest rate. Okay, what then is the discount rate? Discount rate is basically foregone interest rate. Okay, and what do I mean in this case? Are they not the same? Interest rate is not the same as foregone interest rate basically. Now let's assume that we have a firm that wants to double its plant size, and it's going to cost this firm ₦1 million to do so. Okay, so now what this firm, what's an important decision of this firm is, what is the going market interest rate? What is the going market interest rate? So if the going market interest rate were, let's say, 10%, so which is the interest rate now, and this firm still decides to go on increasing its plant size, instead of investing the money, maybe instead of putting the money into maybe a financial asset, or just leaving it in a savings account where it is going to earn a 10% interest rate. So in that particular case, this firm is giving up 10% interest that it could have earned on the capital, on the amount that it wants to use to double its plant size. So that 10% now is a foregone interest rate basically, and it's a discount rate. So that's what we mean. Now this firm actually, there is a way that benefits of a project are calculated. So let's say that the benefit of the new plant size has been estimated, and this firm would only invest in the project if and only if the expected returns on that project is greater when you express as a percentage of the investment, as a percentage of the capital going into it. All right, when we express it that way as a percentage, basically, this firm would only invest in a capital, this firm will only invest its capital into doubling in plant size if the expected returns expressed as a percentage of the capital required is greater or at least equal to the foregone interest rate. So that's it. So if a firm thinks that, okay, not even think now, if after a lot of things that have been put into consideration and this firm realizes that opening another plant, okay, is going to give it, let's say, 8% return on the capital that was used to open the plant, and the market interest rate is 10%, this firm would not pursue the investment, basically, because if the money were left in a savings account, all right, the money would have yielded more money than it is yielding in building an additional plant, let's say over a period of 5 years or something like that. So that's just what we are trying to say here. Now let me come back to what present value is. I will say that present value is the current value of a future amount given a specified rate of return known as discount rate. So the thing here is that you have a future amount in mind, all right, or a future profit, an expected future profit in mind. So the what we are now trying to look for is what amount do we need to invest now to get that kind of profit in the future. So that's what it is all about. Now let me assume that a future amount is, let's say, 8,000 naira. So let me say we have 8,000 naira. So we are now looking at the present value of 8,000 naira in this is a future amount 8,000 naira. We are now looking at what money must we separate now at a specific discount rate that's going to give us 10,000 naira after a year. Okay, because we are looking at, this is 2021, right, and next year is 2022. I don't know when you are going to be seeing this video, so it's the years might be very, very different by then. Now, so what we have to do is, how much do we have to invest now? We don't know. We're trying to look for it. Now, the discount rate, let me just do something like the discount rate is 10% per annum. All right, so we need a value that we don't know, which is like the principal x plus the returns on that principal. So the return on the principal is going to be x multiplied by the discount rate. So let me just leave this as r. So just r is discount rate, just leave it like that. So x multiplied by the discount rate, which is rx, and the two of them is going to give us 8,000 naira in the after 1 year. So now x is actually the present value. So how do we get x out? Now x is so we can say x into bracket 1 plus r equals 8,000 naira, and from here x equals 8,000 naira. 8,000 naira divided by 1 plus r. So that's it. How about in 2 years time? So what are we supposed to invest now? What money must be separated today in 2021 to get 8,000 naira after 2 years at the discount rate of 10%? Okay, so how to calculate that is the first year. So this is how we do it. The first year, this was the initial principal x, all right, plus the returns that you expect on it, the returns that you expect on the principal, okay, which is s plus rx, being equal to 1. But now, because what we are looking at is 2 years, so in the first year you are going to get this, right, where x was the initial principal, and in the second year, x plus rx is now the initial principal. So it's like a compound interest rate. Okay, it's like you, after getting your returns on your initial investment, you then decide to put all the money back into another year again. All right, first year you have this plus this. Now when we solve this out, this is meant to give us 1,000 naira. 1,000 naira. So we then have x into brackets 1 plus r plus r. We can bring x out here. Rx into brackets 1 plus r again. We look at everything equals 8,000. All right, is it right? Okay, rx then 1 plus r. Okay, it's right. Now we collect like terms, so we having x plus r, x plus rx rather, x plus rx. All right, then into brackets 1 plus r, and everything. These are basic. This is just from basic algebra. 8,000 naira. Now what we have to do, we can see collect like terms again. So we bring out x again. So we have x from here. We have 1 plus r equals 10,000 naira, 1,000 naira rather. And then from here we have x into brackets 1 plus r squared. 1 plus r squared equals 8,000 naira. So how do we get our x? X is then equal to x after 2 years, all right, is then equal to 1,000 naira divided by 1 plus r squared. If you notice, the first one that we did, this is more or less raised to power 1. So when the time is 1, when we are talking about 1 year, we have 1 plus r raised to power 1, and because this is in 2 years, returns all the this is talking about what we have to set aside that will give us 1,000 naira in 2 years. So this is now raised to power 2. By extension, if we're talking about, let me call this more of x1, let me call this more of x2. So if it were 3 years, we'll be having x3 equals 1,000 naira, 1,000 naira divided by 1 plus r raised to power 3. So this is the present value of 1,000 naira after 3 years. Okay, present value of 1,000 after 3 years. So by extension, everything present value, which is x, so I could just call that present value, is then equal to, this is the future amount, right? So you can call it future value. The present value divided by future value times divided by 1 plus r. Now the time, we don't know the time that we're talking about, so this is going to be PVN, right? Future value over the raised power L of this raised power n. So this is actually what we are supposed to do. And I think in other areas we might call this the net present value, but that is when we get to add all of the respective present value of whatever future amount that we are looking at. So I've already explained what we mean by investment as economics is concerned, which is just talking about an increase in the stock of real capital or an increase in capital stock, and then present value, we discussed that, and so this is the formula for present value anyway. So what we just have to do after this particular point is to discuss it, because the question is how important all of this thing that we are doing, how important is it? What exactly is the usefulness? The usefulness of this is that it enables a firm to know, it enables a firm to know if it can pursue an investment or not. All right, and we are going to treat an example right away. Here we are. I still decided to leave the definition of present value on board so that we are going to follow up. So present value is the current value of the future amount given the specified interest rate of return, and I mentioned the specified interest rate of return is known as the discount rate. So now we have this example, we have this data on the board. There is a firm wants to invest in a new tractor, and the tractor costs 120,000 naira. So that's the capital outlay, right? 120,000 naira. But the firm has been able to come up with what it calls the expected profit from buying the new tractor. So let me just say that the cost of the new tractor, let me just say the cost is 120,000 naira. Alright, so over 5 years. Now the question is that should this firm invest in this tractor? If you look at it from the point of a layman, okay, you might just look at it that okay, a firm is investing in 20,000 naira in a tractor, and at the end of 5 years, it's going to be getting a 160,000 naira profit. Now, let me tell you something. This is an expected profit. All right. So we have an expected profit of 160,000 naira after 5 years. This is not expected revenue. So that means expected revenue is 280,000 naira from this. If expected profit were 160,000, of course, and we know our revenue is what the expected revenue is going to be. The cost 160,000 naira plus the expected profit. Okay, so expected revenue, let me just call it total revenue. Let me just say base E. Expected revenue is then going to be equal to the costs, all right, plus what profit. If you recall that to calculate profit is usually total revenue minus cost, right? Yeah, when you break cost then you have profit there. So expected total revenue on its own is the cost plus the expected profit. So in this case, cost is 120,000 plus expected profit is 160,000. So that means expected revenue is what 280,000, which is kind of a good bargain. All right, for a period of 5 years. So you might just look at them and you might think, what is there to think about? This firm should have obviously invest in a new tractor. Now let us look at it from the aspect of present value to see the amount of money that should be allocated today in order to yield an expected profit of 160,000 over 5 years. All right, and that is then going to inform our decision on what to advise this firm to do. Now recall that the formula for present value is what the future value divided by 1 plus the discount rate raised to power the number of years that we are talking about. So if this is the expected profit of this investment after year one, so what it means is that let's calculate the present value of this expected profit. So we are going to calculate the present value of the expected profit for 5 years. Now if you look at it, in later years, the firm has already estimated that the expected profit from the investment on this new tractor is 0. Alright, so after 5 years there's nothing more. Alright, so now the first year, PV1 is going to be equal to so future value is talking about expected profit in this case. So expected profit of 10,000 divided by 1 plus a discount rate of 10% simply means 0.1. 1 plus 0.1, then raised per 1 over here. So we have 10,000 naira divided by 1.1. And for my calculation here, I would like it if you can use your calculator to follow up. We have 9090.91. So this is the amount that must be separated in order to get a future value of 10,000 naira after a period of 1 year. Now for the second year, we do the same thing. So now we have 10,000 naira divided by, so I could just say 1.1 straight away, 1.1, then raised by what? 2, because it's, look at the number of years, raised by 2, and this is 10,000 naira divided by 1.2 raised by 2 here is 1.21, and the total of this is 8,264.46. Like I said, I would like it if you can follow up with this. Now the present value for the third year, so present value of this expected profit, so what will be separated as after 3 years we need an expected profit of 40,000 naira. So we have 40,000 naira divided by 1.1 raised per 3, and this is 40,000 naira divided by, so 1.1 raised per 3 here is 1.331, and that is going to give me that's giving us, what was it? Okay, you are following up, right? 30,000, yeah, 30,000 and 52, right? 30,052 point 56. All right. Then for the fourth year, so present value of the expected profit of 40,000 naira for the fourth year. Is it 40? No. This is going to be 50,000 naira for the fourth year. So we have 50,000 naira for the fourth year and 50,000 naira for the fifth year. So we have 50,000 naira divided by 1.1 raised per 4 equals 50,000 naira divided. So 1.1 raised per 4 is 1.464. Yeah, so you're following up. I like that. 1.464, and this is 34,150. 34,150.67. Okay, then the present value of the fifth year. So what was this separate? After 5 years, we'll be having this. So of the fifth year is what was this separate now? After 5 years, will give us 50,000 naira. Okay, at this discount rate. So we have 50,000 naira for the fifth year divided by 1.1 raised per 5. So this is 50,000 naira divided by 1.1 raised per 5 is 1.6105. Now at the end of the day, we're having a present value of 31,046.67. So now the net present value is what we are going to consider and see something. So the net present value is then the sum of the individual present values over the period of 5 years. So when we add this guy and these 3 other guys, when we add them up, what we are going to be having is 112,000 as is it 604 112,604.47. So this is the net present value. Now we are going to consider, the next step is consider this net present value to the initial investments in buying this new tractor. So now we can see from our calculation that the net present value is this amount. So what is the implication of this? It's just telling us that if this firm decides to just put this money into, let's say, a savings account that gives 10% per annum over a period of 5 years, it is going to get 160,000 back in terms of 160,000 expected profit. all right, over a period of 5 years. So that is telling us that the initial investment of 120,000 naira in purchasing the tractor is too expensive. It is too much, all right, and because of that, this farm should not buy the tractor. So that's something important about net present value. If this value had been equal to 120,000 naira, so that means it's a good it's a very good investment, because that is what it actually is. But now, if this farm should decide to buy this tractor and get this expected profit over a period of 5 years, it simply means that it is shortchanging itself, because it can also get that amount in terms of interest on its initial money if it leaves just this amount, all right, in a savings account that yields 10% interest rate, for example. So so that is a wonderful thing that we get to learn about the net present value, and I think this is pretty much useful when we are looking at what happens out there in firms. It may not be this simple, of course, but then this understanding is very, very essential in knowing some of the things that investors and firms look at by the time they decide to increase capital stock or decide not to increase the capital stock. So in this particular case now, this firm is not going to increase its capital stock by purchasing a new tractor. So that's it. Now I'm going to give an assignment, and the assignment is simply that: what if the discount rate had been 6%? What if the discount rate had been 6%? Are we still going to be having a net present value of this amount or not? Now I'm going to give you a hint, because basically you have to solve it out to know if it is right or not. So the hint there is that if the discount rate now is 6% over a period of 5 years, all right, over a period of 5 years, so that means the speed at which the expected returns will come is already small, it's already lower. Initially the speed was 10%, for now the speed is just 6%. So your assignment is solving this whole thing. Okay, where the discount rate, oh, I left my marker open, 6%. Okay, where the discount rate is 6%. Now I was trying to explain that the what do you call it now? The rate at which the returns are coming now has reduced. So the rate at which the returns are getting multiplied has reduced from 10% to 6%. The implication of that is that there is going to be a higher net present value, because to get the same amount when the speed has reduced simply means that the size of this really has to be big. Alright, so it's more or less saying like 10 times 10 is 100. Alright, but okay, no, don't let me use 10 times 10. So let's say we have let's say, what can give us 100 again besides 10 times 10? 20 times 5 is 100, for example, and then we've reduced 5 to 2. So that simply means that what must multiply 2 to give us 100 has to be higher than 20, which is now 50. Alright, so that's exactly what is going to be happening here. I'm not saying you're doing a direct multiplication. No, that's not what I'm saying. I'm just trying to explain. I'm just trying to like give you a kind of analogy of how to understand the kind of answer that you're supposed to get. So the assignment is, when your discount rate is 6%, what is the net present value that is needed to get this expected return of 160,000 naira? Whatever you then get, you then compare it with the investment that this firm is trying to make in purchasing a new tractor, and conclude if it is profitable, right, for this firm to buy a new tractor or not, based on the analysis that you've done. Thank you very much. If you enjoyed this video, please click on the subscribe button. I don't think I should say that again. We have several other videos for you to enjoy, so I would like to see you around next time. Thank you very much. Bye.
Please like and subscribe.